Well, having declined by 2 index points during quarter 4 of 2012 to -3, the FNB Consumer Confidence Index slumped by another 4 points to -7 in the first quarter of this year. The CCI is currently at its lowest level since the first quarter of 2004. And here to discuss this further with us is Sizwe Kletlana. He's the chief economist at FNB. Sizwe, thanks so much for joining us this afternoon.
Good afternoon.
Consumer confidence slumping to a 9-year low in the first quarter. Things are not looking too bright when it comes to the consumer in the country.
Yes, so every 3 months the PR surveys about 2,500 households. They ask them 3 questions, which makes up the composite index, which is: what is the household's economic outlook, or the rating thereof? What is the household's rating of their own financial position in the next 12 months, and whether now is an appropriate time to make a big financial commitment by purchasing durable goods. And there was an across-the-board deterioration of all the underlying subcomponents. The economic outlook sub-index and the rating of the president as appropriate to buy durable goods moved further into negative territory. In other words, a bigger majority of consumers are negative about the economy and are cautious about making financial commitments. And with respect to the own financial index, there's still some resilience there in the sense that consumers, or a majority of consumers, are still positive about their own financial prospects, but the majority of those positive about their own financial prospects halved. And another thing that I can mention is that if you then split it by income groups, that resilience in own financial prospects seems to stem from the higher income groups, whereas the lower income groups have really been suffering, and that comes through in a much more bearish stance from them.
And of course, the lower income groups make up the majority of South Africa. Unfortunately, Sizwe, you said 2,500 households are surveyed. How many of those are the lower income groups? How skewed is this survey?
Okay, so the survey is not skewed at all. It's actually equally weighted across in terms of the representativity. So it does give us an accurate picture in terms of the sample of what's going on. The only thing that one can mention is that, of course, the higher, even though the lower end of the income spectrum are the ones that are suffering the most, it's the higher end that's doing relatively better, but obviously the higher end does tend to have most of the purchasing power. So the situation there will obviously be a little bit mixed.
What's interesting is there's always been a divergence, in sentiment when it comes to outlook from consumers about the national economy to their own financial situations. To what extent is that divergence still in play, even though both have been deteriorating?
Well, yeah, so it seems that whatever is happening, or whatever bad is happening to the neighbors, and that's been something that's been ongoing for a long period of time. So I would say that that divergence remains, but there is some movement towards a convergence. In other words, own financial prospects are starting to abate in terms of the majority of consumers that are positive about that. But if you actually think about it, it's in line with the deterioration, or the most negative impacts of the deterioration in consumer fundamentals, because where the deterioration has occurred is, for example, in job losses, which would probably most negatively affect the lower end of the market, given the fact that it seems to be focused on the mining sector, and possibly to a lesser extent in the agricultural sectors. And when it comes to how rising inflation has negatively impacted on real disposable income, it's the cost push pressures of inflation that are pushing overall inflation. If you look at the petrol price, we're up 22%, I think, to 13 Rand 20, a record high. And also food has been a major driver of inflation. And those factors tend to have a more negative impact on the lower end of the market than on the higher end of the market. And therefore, I think this outcome is in line with those fundamentals.
I went to bed last night quite happy because Manchester City beat Manchester United 2-1 at Old Trafford.
I was also very happy about that.
It was a nice sunny day. Wasn't it fantastic? Yeah. There wasn't much traffic on the roads this morning. It was a sunny day in Cape Town. And then you give me this and plunge me into depression. You say not even at the height of the global financial crisis in 2008 were consumers as downbeat about the country's economic prospects. What this tells me, when you mention things like transport and agricultural sector strikes, is that the South African survey pool that you've got is becoming more and more aware of its situation. I mean, there is a certain educated part, the higher income earners presumably, but more and more people are becoming more and more aware, and I think politicians should take note of this.
Well, that's true. So let's just go back to the numbers very quickly. It's not that the higher end of the market is not negative. Their consumer confidence has actually declined quite dramatically because their rating of the present time to make a big financial commitment, that's declined by quite a bit. What's also declined is their rating of the outlook for the economy. However, their own financial prospects remain resilient. So I don't know if people are standing next to the price stand in the higher end of the market and saying, well, things that are happening are bad, but they haven't happened to me yet. Whereas in the lower end of the market, bad things are happening, but they're also starting to bite in terms of actual income and actual earnings. So I think that distinction we must be cognizant of. But the other thing I then wanted to mention with respect to the difference between higher LSMs and lower LSMs is the fact that I don't think we should then extrapolate this negative outcome as if it's a one-way bet in terms of now painting a doom and gloom situation, because the economic fundamentals as they relate to the consumer have deteriorated. However, I think that there's also been, or the survey has picked up a lot of non-economic factors that have also led to a deterioration in consumer confidence. I mean, over the last 8 months, opening the TV, we've been confronted with a lot of non-economic news, but that's also been very negative.
Yeah, taking a look at something that affects us all, the rand exchange rate. We've seen that depreciation come through 20% against the dollar since the first quarter of 2012 in the rand exchange rate, and that's led to what? Upward pressure on imported goods, fuel prices as well. What's your outlook on that front? Because we've seen the rand making somewhat of a comeback this morning. Yeah,
so I mean, we've held on to the view that the rand, relative to the levels we've seen over the last, say, 2 or 3 months, has been fundamentally becoming undervalued. I mean, if you look at the rand, we've moved from about 730 on average in 2011. We then moved from 730 to 830 during the first half of last year. Incidentally, that depreciation occurred in line with all other risky currencies, as we had that intensification of the Eurozone sovereign debt crisis and that general risk-off market move. However, if you then look at the average exchange rate of the rand, say you compare third quarter of 2012 to the average of March last year, we're about 11% down, whereas everyone else in our peers is either flat or have appreciated. Now, I think what caused that movement was the fact that South Africa then had widening twin deficits. So our current account deficit widened to 6.3% last year from about 3.5% the previous year. Our budget deficit was wider than what the MTPPS expected, and so the rand depreciated off the back of that. But I also think there was then market expectations that these twin deficits would then continue. Now, if you actually interrogate why we had a widening in the twin deficit, well, the miss in the budget deficit was a function of lower company taxes, which was a function of mining production essentially collapsing in the second half of last year. The current account deficit, that was also a function of much lower than expected imports, which was also a function of lower mining production. So to the extent that you view the second half of last year, what occurred in mining, as a shock, and therefore that there should be some sort of normalization, not to ideal levels, but relative to that shock level of the second half of last year, we should see a narrowing in both deficits. And when that starts to sink in, I think we should see an appreciation of the exchange rate. Incidentally, if you also then look at South Africans' fundamentals relative to our EM peer group, in terms of then our GDP growth, our inflation rates, and so on, we're also not out of line. So for me, that's a picture that suggests the rand was oversold and that there's some retracement that's likely.